Hey students, welcome to week 3 of Accounting and Business 222. This week we're looking at defining the receivables, defining what receivables are. We're going to be explaining the allowance method for, it's called valuation of receivables. So this week is really about receivables. We're looking at the allowance method of accounting for uncollectible amounts, which happen in every single business. There's always some uncollectible revenue. And then we won't be looking at it in this particular short overview video, but there are some pretty straightforward calculations you need to do and need to learn when it comes to calculations for notes receivable, interest payments, and that sort of thing. And that's in your book, so make sure you check that out. Let's talk about accounts receivable for a moment. So accounts receivable, the definition is they're short-term financial assets that come from, they result because of sales on credit, and they're often called a trade credit. So in setting credit terms, companies have to keep in mind, I'm going to give you the short version of this. When you set credit terms with your suppliers, people that with your customers, people who owe you money, it's a receivable in, so it's from your customer. You set those so that it doesn't impact your cash flow. In fact, you should always do a cash flow, look at the credit terms you set with your customers and the credit terms you set with your suppliers, the people you owe money to. And it's always best to keep your customers on very short payment terms so they pay you quickly, and take your suppliers and extend them out as long as you can. So long payment terms with suppliers, short payment terms with customers. Anyways, so accounts receivable really ride and fall on the credit terms that you set up with your customers. If you're too lenient with those credit terms for your customers, then you'll be paying cash out the door for expenses to generate the revenue, but you won't get payment from the revenue. It goes into an accounts receivable. So, but it goes into when it goes into receivables, it's really not cash heading in the door until the customer pays you. So if you set those terms too long, you could be making payments 1 month and actually not getting the cash until 2 or 3 months later. In the business that I'm in, I'll show you this chart real quick here, and I'll get back to my business that we're in. So this one shows, for typical industries, how much accounts receivable are as a percentage of the total assets. And it's different for each industry because each industry's terms are different. In the automotive world, where I live, our terms are with our customers. Our customers demand anywhere from like net 60 to net 120. Many of our customers are at net 90 as an average. So we provide a service to the automotive customers that we work with, and then we don't get paid for that service for 90 days later, and it's moving to 120. Almost sounds criminal, doesn't it? But anyways, you can see the different percentage of total assets that accounts receivable are based on the different industries here. Now, accounts receivable also has kind of an ugly side to it. It's called the uncollectible amounts, or the bad debt. And there's 2 different ways of accounting for those uncollectible accounts. One's just the direct charge-off method, and it's really not an accrual accounting method. And the other one that we focus on in this course is called the allowance method, and it's according with what you call accrual accounting. And again, with accrual accounting, you're always trying to match the revenue with or recognize the revenue and the expense in the same time period. Even though cash received or cash dispersed for expenses may occur actually in different time periods, you want to accrue for them so that it happens in the same time period. It gives you a better, if you remember back from chapter 1 or 2, gives you a better feel for what's going on with actual net profit during that time period. If you look at, let's look at notes receivable for a minute. That's another receivable. That's basically like a loan that your company makes to somebody. It's like a promissory note. And as the text says, it's an unconditional promise to pay you back some money. And it could be a person or some company that signs the note. When you give them money, they make a promise to pay you back. You're basically acting like a bank in that case. Here's a quick picture of a promissory note. I don't see these used very often, quite, at least in our business. We don't do this very often. Maybe occasionally, if the owner of the company makes a loan to an employee or something like that, you might see this, but not very often where somebody would owe us a bank note, sort of a promissory note. Usually it's accounts receivable is big for us. Let's talk about the allowance method for accounts receivables. I'm not going to go into any great detail here in terms of the journal entries. Those are in your text. But once again, the allowance method is a way, it's used from accrual accounting. It requires allows for losses from bad debts to be matched with the revenue in the time period that they actually happen. So it serves to value the accounts receivable on the balance sheet. So it puts a true value of accounts receivable on the balance sheet. It's interesting, because managers, you can't identify at the time of the sale which customers are going to pay and which ones are not. So there's losses from these uncollectible accounts that you have to make accommodations for. So, for example, in a typical bad debt situation, they talk about the Mandy Sales Company here. There's an adjusting entry that you would make in that it would increase what's called the uncollectible accounts expense. So expenses going up for this uncollected debt. And it also increases what's called the allowance for uncollectible accounts, which is on the asset side. And remember, even though it's considered an asset, it's actually a bad asset. It's an allowance for an uncollectible account. All right. Now, when we talk about disclosures of receivables, like how you recognize it, how you kind of collect it, and how you like record keeping it, the payee, that's you, that's us, that's the company that the money's owed to. So a payee includes all the promissory notes it holds that are due inside of a year. That's called the notes receivable, and it's on the current asset side of the balance sheet. And then any interest occurred because of those notes is also included on the current asset sheet, or current assets as an interest receivable. The uncollected accounts expense, though, doesn't appear on the balance sheet. It appears as an expense on the income statement. So again, notes receivable show up on the balance sheet, and the accounts receivable show up on the balance sheet. But this uncollectible accounts expense, where you actually account for this accumulating bad debt, shows up as an expense on the income statement. So the allowance, though, for uncollectible accounts appears on the balance sheet as a contra account, and I'll show you an example of that in a minute. So remember, the actual expense side of the uncollectible account is on the income statement, but the allowance for this uncollectible accounts is actually a balance sheet item, and it's called a contra account. You may remember those from earlier on in the first course. And really what the contra account does, this allowance for uncollectible accounts, is it reduces the actual accounts receivable by the amount of what you think is going to be the bad debt. So it reduces the accounts receivable to the amount expected that can actually collect it. And here's an example of that. So you can see they list the current assets on the balance sheet. There's cash for $20,000, short-term investments of $30,000. The notes receivable is $15,000. Notice the interest down there for that on that note's $1,000. Again, those are all part of the asset side of the balance sheet. The accounts receivable is $200,000, but we've determined that $12,000 is going to be uncollectible. All right, so that shows up as $188,000 net, if you will, because of the $12,000 contra account as part of the uncollectible amount. So the actual accounts receivable would be valued at $188,000. Let's talk about these some different accounting principles related to these uncollectible accounts and expenses. So there's two different ways to kind of predict, if you will, or account for the uncollectible accounts of the bad debt. One of them is through a percentage of net sales, and the other method is through an accounts receivable aging method. And really what you're doing is trying to, like when you're budgeting, you want to know about how much of your net sales is going to be impacted, or how much of your receivables are going to be impacted by bad debts. And you have two different choices. You can do net sales method or accounts receivable method. The percentage of net sales method is pretty straightforward. There's another slide come up I'll show you here in a minute. It's the amount of this year's net sales that you think you're not going to be collecting on, and that sort of sets the precedence for the expense in next year's budget as well as kind of correcting for this year's. So, for example, in this company, Varda company, they had sales of they have sales of $322,500 in 2014. They gave away some discounts for $2,500, $20,000 sales and returns, and at the time they did this, there was about $1,800 of uncollectible account or uncollectible revenue. So it's an allowance for uncollectible accounts of $1,800. And if you look down here, 2011, 12, 13, this is the percentage of basically bad debt for the year: 1.96, 2.34, 1.69. So overall for those 3 years, about 2% of their revenue or their sales is lost because of bad debt or this uncollectible accounts. And so what you would do in the case of Varda, you would estimate for 2014 what is the bad debt going to be. And you can see it's 2% times the net amount of the sales minus the discounts minus the returns, and it's about $6,000 is what they're expecting using the net sales method to be uncollectible. So again, you can see you can see the journal entries on the slide here, and make sure you check those out in the book. The other way to do this to account for bad debt is based on accounts receivable, or the aging method. And the aging method is the amount of the ending balance of accounts receivable that are simply not going to be collected. If you're an accountant or you know somebody in accounting, you can always run an aging report to show you how many of your customers are not paying you beyond the terms that they agreed to. So the aging of accounts is the process of listing each customer's receivables, each customer down one side of the sheet of the paper, and then you'll see what their current invoicing is, and then you'll see how far they are for 31 to 60 days, 61 to 90 days, 91 to 120 days, etc. And so you know how past due each customer is. And you use those numbers to predict how bad generally your customers are going to be in the following year as you're doing your budgeting and that sort of thing. So comparison of the two methods, both the percentage of net sales method and the accounts receivable method, all about estimating the bad debt that's hanging out there for the accrual accounting approach. The percentage of net sales method, it's an income statement approach. It hits the income statement. The accounts receivable aging method hits the balance sheet. Okay, the last thing, we're not going to talk a lot about this, but there's a number of calculations that you can use in different ways you can get at promissory notes and how people pay you and what they pay you. Make sure you check that out in the book. So again, be sure to read Chapter 9, Sections 1 through 6. Contact me with questions. Listen, have a great week.